Welcome, everyone. It's great to have you all here with us this evening or afternoon, wherever you happen to be in the country. Larry, I'm really honored to introduce today's speaker, Larry Pon. Larry is a certified public accountant, personal financial specialist, certified financial planner, enrolled agent, United States Tax Court practitioner, and accredited estate planner, and he is based in Redwood Shores, California. Larry has been in practice since 1986 and enjoys helping his clients reach their financial goals. He frequently speaks on tax and financial planning topics to tax professionals, financial advisors, and the general public all over the country. Larry received his Bachelor of Science in Business Administration with an emphasis in accounting and finance from the University of California at Berkeley, and his MS in taxation from Golden Gate University in San Francisco. He teaches income tax at the College of San Mateo and is a longtime member of NAEA and CSEA. And one more note, because of the amount of terrific content we have today, we're going to try to hold questions until the end of Larry's presentation. So like Jeff said, use the Q&A to post your questions, but if you do it early on and don't get a response, don't worry, it just means that we are going to hold the questions until the end because we want to make sure that Larry, our speaker, has enough time. And with that, I think I'm going to hand it over to you. Larry, the floor is yours.
Well, thank you, Phyllis, and hello, everybody. Let's see here. So let's get started. We have a lot to go over today, limited amount of time. Yeah, this is a spotlight on Form 1041, and we're going to talk about trust because in our practices, going forward, we're going to see more of these, right? For various reasons, we will, mostly because our clients are dying, and we got to deal with the trust that they create. So here's what we're going to cover today. We're going to talk about why people set up trusts, the types of trusts, fiduciary accounting, that's going to be super important. And of course, fiduciary taxation, taxable income and tax liability, how to calculate distributable net income, also known as DNI, simple trusts and complex trusts. Now, there's a whole lot of other trusts. We're not going to cover all those tonight, but we can have a more advanced class later. So let's start with, why do people create trusts? Well, for most of our clients, they're doing it for estate planning purposes, right? Because what happens if you don't put your assets into a living trust? A living trust is a revocable trust. It's a revocable trust. It's basically invisible while you're still alive, but it kicks in after you die. That's when it becomes an irrevocable trust, depending how you set up. In some cases, it's used to minimize estate taxes, possibly, but most importantly, it's for estate administration. If you die without a trust, you have a will, it's a public process. And if you're really bored, you can go to your county courthouse, go to the probate court and start I go to my courthouse and there's a wall of clipboards, and the clipboards have all the probate cases going on. There could be names you recognize. Or you might say, hey, I loaned him some money. He owes me money or whatever, right? It's a public process. If you want some privacy, we tell our clients to set up a living trust. That's really important. And, or the other thing is we ask our client, hey, when's the last time you updated your trust? Well, 1992. Well, we've had a few tax law changes since then. So it's probably a good idea. To get that trust updated. And, there's always changes in the estate laws, and we'll talk about that a little bit later. Income tax planning for some clients. There's something called income splitting where, instead of the individual paying all the taxes, we can have the trust pay some of the taxes. So it could be for income tax planning purposes, or not even for tax reasons, right? For some clients, protection from creditors. If we put assets into an irrevocable trust, it's not yours anymore. So it could be protected from creditors. They can't get to it. Or for many of our clients, manage beneficiaries' access to capital. If you get I've seen this happen to many clients. One young man, 18 years old, he got $900,000. That was not a good thing. He was a really fun guy to hang out at parties and all that, but he didn't really make anything of himself because I think that was the biggest mistake that family made was to give him $900,000 when he was 18 years old. In some cases, we still have trust, so they get a trickle of money or someone manages the money for them. And I've had cases where this one estate. Believe it or not, this estate, its main asset was renting out land to car dealerships here in California, like car dealerships, well-known car dealerships. And her share of the income was $40,000 a month. Well, unfortunately, she's a drug addict, and I learned a lot about drug addicts from her. But that money had to go into a trust, and we had a trustee, a professional trustee, not a family member, manage the distribution to her because otherwise it'll just get blown. It'll just get blown. So that's why we would do that. And it's not for tax purposes. It's just to keep her from spending all the money, giving it away, and doing bad things with it. So those are some various reasons we create trusts, and there's all kinds of trusts. So some tax planning considerations with a trust when your clients set up a trust. So there could be a possibility of ability to shift income. You know, um, does the income go to the beneficiary or the trust retains the income? That could be the case there. Or timing of distributions. Do we give them the money now? Give them the money when they're 25, 35, 65, or you need money to buy a house or something like that. Sometimes the trust might be holding certain assets such as real estate or certain stocks, whatever, can make distributions, property distributions. Possible year-end decisions, not a lot of flexibility there, possibility. And of course, because currently under the Tax and Jobs Act, there's no deduction for expenses that are subject to a 2% of AGI limitation for miscellaneous deduction. But for administrative expenses for a trust, those can still be deducted. So we just got to make sure we capture all that and deduct it on the trust return. So, what kind of year end? So most trusts generally have a calendar year because the beneficiaries are calendar year. There are some exceptions. So their trusts are exempt from tax under Section 501A. So those are tax exempt trusts. We can elect a fiscal year or wholly charitable trusts under Section 4947A1. So that could be a charitable remainder trust, a charitable lead trust, and those type of trusts. We can elect a fiscal year end or qualified revocable trust have elected to be treated as part of an estate. And we'll talk about that next. So that could have a fiscal year, and many times we do that. Or grantor trusts treated as wholly owned by the grantor under Section 671. Most of the time we do elect a calendar, or most of the time we use a calendar year in for trust. However, in the case of an estate, you can file Form 8855. That's the election to treat a qualified revocable trust as part of an estate. It's part of an estate. So with an estate, you can elect a fiscal year based upon the death of the owner, death of the decedent, when they died, right? And what's the advantage of that? Well, it depends on the estate. Some estates, we can close those out within a year. So instead of having to do two tax returns, so for example, your client dies on August 30th or 31st, at the end of August, um, you can all their assets are in a living trust, and we could just do a calendar year trust, which means from September 1st to December 31st would be a trust return, and then another one for the subsequent year. Well, if we make this election to treat the qualified revocable trust as part of the estate, we can do a fiscal year trust starting on September 1st, and ending August 30th of next year. And it works really well if you think we can get this estate wrapped up within a year. In many cases, we could. So instead of charging a client to do two tax returns, we do one tax return. And the other advantage of that is that the income from that trust is reported on the subsequent year return. So, for example, your client dies on August 30th of 2025. Well, we elect a fiscal year, elected as part of an estate, and the executor or the trustee is very confident they'll get this estate wrapped up because there's not that much work to do, and there's no weird beneficiary. It's all the family and all that. So it's pretty straightforward. And I say, well, if you can get this done by August 30th of next year, we'll just file one tax return. And then the K1, the tax return would be using a 2025 1041, not 2026. We use a 2025 1041 with the K1, but it gets reported on the 26 beneficiaries' personal returns. So it's kind of a way of pushing the income into the next year instead of pushing income into this year. So it depends on the situation, what's in the estate and all those kind of things. The date was actually a real date for our client. She died in August, and we did do this elective fiscal year because she had a lot of money in mutual funds. Well, mutual funds, they pay most of their dividends and their capital gains in December, right after Christmas, right at the end of the year. So if we did a short year, that's a whole bunch of income being pushed into the current year taxes. So we're just pushing out to the next year. And that worked out pretty well because there wasn't going to be a whole lot of income after that because the financial advisor is going to sell all the funds and then distribute the cash to the son and daughter. So that's how that worked out. And so for 2026, there wouldn't be that much income. So, so this is the form to tell the IRS that we're making this election. All right. So choosing desired year-end for an estate. The executor administer. Polling number 1 is up. So please click on that. I think you need to click 6 out of 8, right? There's 8 polling questions. So if you do 6 out of 8, you'll get your 2 hours of CE. All right. So the executor administrator of a decedent's estate is free to choose any tax year. It's an opportunity to defer the beneficiary's recognition income received by the estate. But don't pick a middle of the month. Tax year must end on the last day of a month, and it can't be more than 12 months. So it kind of makes sense, right? If she died in August, and then we started in September or something like that. Okay, elections made by, and you make this election. You tell the IRS by filing the first Form 1041. So you file the first return. Okay, so when do we have to file a 1041? So in general, for estates, it's every estate with the gross income of greater than $600. And if it's less than $600 of gross income, then no 1041 is required. And so the due date is the 15th day of the 4th month after the end of the tax year. So if it's a calendar year, I can count those. That's April 15th of the calendar year. Now, you can file an extension with Form 7004. It's an automatic extension for another 5 months. Just like individual taxes, you got to pay the taxes on the due date. So you still got to pay the taxes. The extension just gives you more time to file the return. And then after 2 years of the existence of the trust or the estate, the estimated taxes are required after the first 2 years. So just like an individual, the dates to pay your estimated taxes are April 15th, June 15th, September 15th, and January 15th. Of course, if the 15th lands on a Saturday, Sunday, or holiday, it's the day after that. Or we've seen this in the last few years is if there's any disaster relief. So these dates could be pushed out due to disaster relief. So just take a look at where your clients are located and see if they qualify for that disaster relief. All right, so here's a a picture of the 1041. Here's the first page. Most of us are filing electronically, and we can file these electronically. That's pretty good. Most of us are not going to be doing this paper-wise, but if you look on the bottom of the form, there's the signature line and all that. So you can file it paper filed. And when do we paper file these? Oh, because we find out that, oops, you haven't filed a trust return when you should have. And then we're doing back returns. And then we're for beyond, was it 2 years or 3 years? In our e-filing system, we can't e-file, we have to paper file. So they're generally e-filed, and that usually works out pretty well. So let's take a look at the top of the 1041. So top of the 1041, uh, box A is super important, right? So check all that apply. So first one's decedents estates. That's what we call them, estates and trusts. So what's an estate? Estate is created at the death of someone, upon their death. A trust can be created while they're still alive. So that's the difference between a trust and an estate. So if it's a decedent's estate, the estate of Larry Pond, you check that first box there. We're going to go into some definitions a little later here, but you can have a simple trust. A simple trust means it has to distribute all the income to the beneficiaries. The trustee cannot retain any income or make decisions on what they distribute to the beneficiaries, has to distribute the income. It cannot have charitable deductions and those kind of things. That's a simple trust. And then there's complex trust, which comes next. What's a complex trust? According to the IRS, it's a trust that's not a simple trust. So that's the definition of a complex trust. But usually we'll see the complex trust when the trustee has the power to distribute other than income amounts. We'll just distribute $2,000, or you need to buy a house. That's when I'll make a distribution or something like that. There's qualified disability trusts, also known as special needs trusts. ASBITs, those are trusts that can be shareholders of S corps beyond the scope of the class. We're not going to go into that one. Grantor type trusts, you might see some of those. So what's a grantor type trust? A grantor type trust is kind of taking the best of all worlds type situation. So you might hear lawyers set up something called an intentionally defective grantor trust. It's like, who picked that name? Why would I buy something that's intentionally defective? But the purpose behind that is that if you put assets into an intentionally, known as an IDGET, intentionally defective grantor trust, I'm the grantor, I still pay taxes on the income. So that I still pay taxes on. However, the assets are being gifted, so it's outside of my estate. So it's kind of sort of the best of both worlds kind of things. Then we got bankruptcy estates and Chapter 7, Chapter 11, and pooled income fund. Those are more for charitable organizations. So, very important to pick the right type of trust. We've seen that mistake, right? Name of the estate, the Larry Pond Trust or whatever. Name and title of the fiduciary, Jim Jones, trustee. Employer identification number, and that's always tricky, right? So hopefully you're working with a good attorney who, work together here, right? And name the trust appropriately and all those kind of things. Because, when we prepare the return, or when we, prepare the return, it's always important to get that EIN letter from the IRS, right? Most importantly, page 2, right? Page 2 will have the code, the control code, the four-letter code that you need to enter into your e-file system to be able to process the return. So not just that some lawyers just give me a copy of the page from the website. No, 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 no. I want the actual IRS letter because they'll have that 4-digit code. And it's usually the first 4 letters of the name of the trust. But then I have 3 letters of my name, so I'm not sure how that works, but whatever, right? So it's very important to have that. So date and the created D, that's not the date that the client wrote the trust. It's not the date. It's when the trust actually springs to life. Usually, if it's coming from because it's become irrevocable upon someone's death, that's the date of death or something like that. Or actually, it could be the date it's funded. I set up this trust. It's for my kids. Um, I set up on June the 3rd. So yeah, that could be the date it's set up. Okay, name, address, street address. Box B, number of K1s, our software counts that for us. Box F, check applicable boxes. Initial return. Change in trust name. Because if the name doesn't match that EIN letter, you'll get a rejection, right? Or you get some confusing letter from the IRS. So we want to minimize confusing letters from the IRS. That's why we really want that letter from the IRS, the EIN letter, so we can match the name to that letter. Now, it might not match to what's on the document itself, but we're just doing taxes here, so we want to make sure we're consistent. And then that's why it's helpful for the lawyers to work with it, or we get the ID number, right? Because we'll type in the right name, and then that's what we'll put on the return. All right. Let's see. Final return. That's when the trust is terminated. It's done. It's distributed all its assets. We're letting the IRS know. Don't look for another 1041. Change in fiduciary, another trustee. Amended return. So there's no 1041X. If you need to do an amended return, you have to do a 1041. Check the box for amended return. Let's see. Change in fiduciary's name. Ooh, net operating loss carryback. Change in fiduciary's address. All right. Box E. Do we deal? I don't think we need to deal with that. Yeah, we're not going to deal with. We're not going to really deal with that much. So here we go. Box G. Check here if the estate or filing trust made a Section 645 election. Trust, check here. So that's the form I showed earlier of treating the qualified revocable trust as part of an estate. So it's, you've probably worked with lawyers where they'll say, okay, yeah, do these 5 returns. It's like, well, why are we doing 5 returns? And, some lawyers like to make things a bit complicated for us, but this can simplify things and help lower the cost for the client, especially if we don't really need to do 5 tax returns. Okay, so now the income and deductions on the front page of return looks very similar to the individual return, right? We got box 1, interest income, box 2, dividends, ordinary dividends, qualified dividends, 2B1s for beneficiaries, 2B2s for the state or trust. Um, Box 3, business income. We might see that, right? The owner of a business might have died, and it's still going on. Capital gains, line 4, Schedule D. Line 5, rents, royalties, and partnerships. Your client might have rental property. Well, he died, and it's in his trust, and here we go. We report it there. Uh, Now, one little aside: if your client has a rental property, what does that mean? Yeah, that's right. We need to step up the basis for the depreciation, right? Because upon death of the owner, um, we get a step up in basis, and look at those numbers very carefully. How do we allocate between land and building, or if there's personal property? And again, depends on how big the asset is. If it's a really large asset, should we hire a cost segregation firm to help us figure out how to allocate those amounts? It depends, right? Depends on the client. If it's just a, condo, probably not. All right, farm income, line 7's ordinary income, line 8's the infamous other income. So what shows up on line 8 the most for most of our clients? It's going to be the trust is a beneficiary of an IRA account, right? Do we recommend that? No, of course not. But clients do that. So they name their living trust as the beneficiary of the IRA account. Well, that's income. That's income. And that gets reported on line 8 coming from an IRA account. So not something we recommend, but unfortunately, too many clients do that. So line 8 that's the most common thing I see. If you see other things go into line 8, put in the Q&A here. I'll be curious to see what interesting things you have seen. Let's see, line 5. Other interesting I seen was a client who died, but he was an author. He was an author. And what the interesting thing was his royalties shot up after he died. That was really interesting. So we got the 1099s for the royalty income, and I guess if they know that he's not going to make new books, people buy up all the old ones. All right. Then we got the deductions on box 10 is interest, um, Check if Form 4952 is attached. That's the investment interest form, right? Similar rules as individuals. Taxes, most likely property taxes is the most common. Could be state taxes, subject to the SALT limitation. Fiduciary fees, if only a portion is deductible under Section 67E, fiduciary fees. So we can deduct them if they're paying fiduciary fees. Charitable deduction. Charitable deduction, that's Schedule A. We'll talk about that in a second. Here's a common mistake I run into a lot with charitable deduction. You know, someone died, they got a whole bunch of old clothes and furniture. They give it to Goodwill and they deduct it as non-cash contribution, as you would do for an individual. Can you do that? No, you can't. Only charitable deductions we can claim are deductions that are named in the trust. The trust will say, we're going to give $100,000 to the Heart Association or whatever, right? It's got to be in the trust. It's got to be in the document. Otherwise, just because the trustee wants to give it away, it won't be deductible. So you got to be careful about that. Line 14, super important. That's you and me, right? Attorney, accountant, return preparer fees. Okay, line 15, other deductions, infamous other. Let's see, net operating loss. Okay, the most important one we're going to talk about later is line 16, income distribution deduction. So if we're distributing income to the beneficiary, the trust is not going to pay the taxes there. Now, if it's not being distributed, then that could be zero. Then the trust has got to pay taxes. Okay. Trusts also have the line 20, qualified business income deduction, QBI. And then there's a little bit of an exemption. We'll have a number on that in the slide. So line 23 is taxable income. Then we got the tax, payments, you either owe money or you have a refund. So it's very similar to an individual here, page 1. Page 2 is Schedule A, B, and G. So Schedule A is the charitable deduction. Look at the line here. It says, don't complete for a simple trust or pooled income fund. So simple trust, if your client's a simple trust, there's no charitable deduction. That's going to be blank. Okay. Line 1, amounts paid are permanently set aside for charitable purposes from gross income. And then that gives us our deduction. All right. That's only if it's named in the trust document. Schedule B is going to be really, really important. And, okay. Polling question number 2 is up. Polling question number two is up. Please click away. All right. Schedule B, income distribution deduction. And we're going to go over some examples of this, how to compute this, because this gets us to line 15, income distribution deduction. That's the subtraction from the trust income that the beneficiaries will be paying taxes on. So you got total income, taxes and income. Line 3 is capital gains. Line 4 is any charitable deduction, if any. Line 5 is capital gains. Then we figure out what the distributable net income. Now, look at line 8. Line 8 says, if it's a complex trust, complex, not a simple trust, but a complex trust, enter the accounting income for the year as determined under the governing instrument, applicable local law. And then that gives us line 9 is income required to be distributed currently. If it's a simple trust, that's all the income. For a complex trust, it's could be less than that because it depends on what's being distributed. We're going over an example to illustrate this. All right. Schedule G is the tax computation. I'm not gonna walk through this in too much detail because we have software that does the math for us. So thank goodness for that. But we'll go over the compressed tax table that the trusts have, but trusts also can take advantage of tax credits. Most importantly, the foreign tax credit, if there were, some foreign withholding from a mutual fund or a stock or something like that. Okay, so Schedule G is the tax calculation, and that's where you enter the payments. Okay, let's keep taking our tour of the form, Schedule G, and then below that is other information. And I don't know if I blew up the rest of this because there's some new questions on the form that I want to point out. There's some new questions. Let's see. I think I might have blown this up. So let's move on here. So Schedule G is the is the part 2 of Schedule G, the payments, estimated payments, any payments you made with the extension, any withholding. Line 14, federal tax withholding, if is from 1099, check here. The most tricky thing that I run into is sale of real estate. If the trust sold a piece of real estate, there might be some withholding on that. You'll see that in the 1099-S. Most importantly, state withholdings on the state version of the form. There might be some state income tax withholding, and it never lines up perfectly, right? So sometimes that could be a challenge. Well, here we go, the questions. All right, so let me point out the ones that's the most interesting. Um, we get this a lot. Question number two, did the estate or trust receive all or any part of earnings, salary or wages? And that happens a lot, right? You have a client, they die during the year. So that gets reported on W-2 before they died, but they might be entitled to a commission, a bonus, or stock investing or something like that. Well, if that doesn't go in the 1040, that's going to go in the 1041. So that could be income with respect to the decedent. That's line two here. Uh, line three. Line three looks familiar, right? At any time during the calendar year, did the estate or trust have an interest or signature or other authority over a bank, securities, or other financial account in a foreign country? Yeah, good old FinCEN, Form 114. So sometimes we know that, right? Because if you look at the individual return, that box might be checked a yes, and we might know about that. And of course, that's a whole other issue to deal with foreign bank accounts and all those things. But don't ignore the questions. So read all these questions here. Let me point out a new one. Let's see, where is that one? Oh, here we go. Question 13 is new or relatively new. I think it popped in maybe last year. Was it 14 or 2024 or 2023? Line 13. At any time during the year, did the estate or trust receive, um, sell, exchange, or otherwise dispose of a digital asset? That's the same question that you saw on the form 1040, right? Well, it's on all the forms now. It's on the 1041 here. It's on the 1120, 1120S, and 1065. So digital assets question. Same thing, right? All the same income issues with digital assets. You know, it's like, oh, that's going to be so interesting. So that might be an issue here. Okay. Now here's the K1. Looks very similar to K1s we see for partnerships and S corps. So, very similar here, right? Box 1 through 10 is pretty standard interest income, maybe just a bank account, dividends, capital gains. Let's see here. Line 7, that's when we see net rental income. If the trust has rental real estate, that's pretty typical situation. And then so that would flow to the individual. We'll go over that in a second. So the tax rate schedule. So how's it differ from the individual? It's the same top tax rate, but it's significantly compressed, as you can see here. So you basically hit the top tax bracket at $15,200 of income. 15,200 of income, boom, you're in the 37% bracket. So, that's something you got to keep an eye on because the 24% bracket, 3,100. So it's pretty low, pretty low. So that's one of those tax plan considerations we need to deal with our clients is to be aware of the compressed schedule. Trusts also have the same capital gains tax rates. Again, the numbers are more compressed. So the 20% maximum capital gains rate applies if trust income over 15,450. So, 15 grand or so. 0% up to 3,150. 15% is between the 3,150 and 15,450. So from a tax payment standpoint, yeah, it's a very compressed tax schedule. So we just got to be aware of that. Where do our clients run into trouble with this? It's usually when they name a trust as the beneficiary of their retirement accounts. That's usually something we don't recommend in general. Okay, so the types of trusts. Trusts can be created anytime before you die, and of course that. And the estate only is created when someone dies. So that's when you hear the term estate or trust. Estate only is created when someone dies, the estate of so and so, right? Now, other types of trusts, a grantor trust, we see a lot of clients do this, a grantor trust. So the grantor, you're the creator, the trust grantor, creator, is taxed on some or all the trust's income. And on your software, you check a box. The income is not reported on K1. It's reported on a statement. It'll say interest, dividends, or whatever the income items are. It's a statement, not a K1. So for grantor trust. So the grantor pays the tax. Doesn't matter if you distribute the income to a beneficiary. Doesn't matter if you do or not. The grantor pays the tax. So it's kind of an estate planning technique because I'm transferring assets, but to not use more of my lifetime exclusion, I pay the taxes. So very common things for people to do. So it usually occurs when grantor does not give up control of trust assets, right? We have these type A clients, they're not going to give up the control. Also can occur when the grantor or grantor spouse has a reversionary interest. Reversionary interest means I get the money back. It could be for various reasons. It could be over time, certain events, or whatever. If there's a reversionary interest. And that happens. That happens. Okay. So examples of grantor trusts, and we know the first one, revocable trust. That's your standard revocable living trust. So that's the ones we see the most that we know about. Um, you have retention of administrative powers, which means you control how the investments are managed and all that. Retention of economic benefits. And you control over others' enjoyment. So, sorry, son, you're not going to get any benefits until later, right? And post 1986 reversionary interest trusts. And we had some tax law changes in 1986 regarding these type of trusts. So let's talk about the type of entity. So type of entity, number one, is the decedent's estate. So that's the estate of a deceased person is a taxable entity separate from the decedent. So that happens when you have a client who dies in August. Well, that's the taxes are on the 1040 from January to August, and then after August would be the estate. A simple trust. What's the definition of a simple trust? It requires all the income to be distributed currently. Whatever income's being generated, you got to distribute. You can't keep any of it. The trust instrument does not provide any amounts that are to be paid, permanently set aside or used for charitable purposes, and the trust does not distribute amounts allocated to corpus of the trust. So a trust document, if it has any of these terms in here, it's a complex trust. It's not a simple trust. A simple trust is, it's just a bucket to hold money, and it just pays it out. So not a whole lot of flexibility there with a simple trust. Now, trust can change character. So one year it could be a simple trust. Maybe another year it'd be a complex trust, or a complex trust becomes a simple trust. So those boxes can change over time. So a complex trust is a trust that's not a simple trust, doesn't qualify as a simple trust. Grantor type trust, legal trust under applicable state law that's not recognized as a separate taxable entity for income tax purposes, and grantor have not relinquished complete dominion control over the trust. So that just still gets reported on your 1040. Okay, we had Rev Ruling 2023-2. This was a bit interesting here because what people were doing is that they were putting property into an irrevocable trust. So basis of property acquired from a decedent via an irrevocable trust. So taxpayer creates an irrevocable trust. They retain power. They control assets and all that. Cause the taxpayer to be the owner of the trust for income tax purposes. So for income tax purposes, you're paying taxes on whatever earnings are from the trust. But for gift tax purposes, it's a completed gift. So for gift tax purposes, those assets are out of your estate. So accordingly, the trust assets are not included in your gross estate. This is for our, clients with a lot of assets, right? Because today in 2025, the basic exclusion is what, 13,990,000. According to the big beautiful bill, it's going to be 15 million. And I think that's in the Senate version too, 15 million in 26, and it goes up from there with inflation. So, so for clients with large estates, this is what they do. They set up these type of trusts, a grantor trust. And now what this revenue ruling says, which I don't disagree with, there was no surprise to me. So the IRS says the basis of the assets are not adjusted to fair market value on the date of the taxpayer's death. because the asset wasn't passed from the decedent. The trust already has the assets. You report on a gift tax return. At least you were supposed to. So this is just a reminder when clients set up these trusts. I know. You got these greedy clients. They want everything, right? They want it all. So yeah, I want to get it out of my state. Oh, and also I want to get step up in basis too. No. I know there's some lawyers who disagree with this. I saw a bunch of articles of some well-known estate lawyers who says, we disagree with this ruling. I don't know. I'm a simple accountant, and I kind of agree with this. So no, yeah, this was you set up this irrevocable trust to get it out of your estate. Although you pay taxes on the income, um, it's not in your estate. So why should you get a step up in basis? So if it's in your estate, yes, I agree. You get a step up in basis. All right. So we had a lot of kinds of stuff. These incomplete gift non-grantor trusts, ING trusts. INGs were formed in a state with no income tax. The usual suspects are what? North Dakota, Alaska, Delaware. We see a lot of those. It's a way of avoiding home state income tax. The investment builds up outside of your state. So we have DINGs, those are Delaware trusts, NINGs for Nevada. Well, New York closed this loophole back in 2014. So sorry, can't do this in New York. Because in New York, if you do one of these trusts, the income's still taxable on your New York state return. California, being the trailblazer they are, they copied New York, and we had this in 2023. Yeah, it took a few years. So California's finally changed the law to agree with what New York is doing. So be careful if your clients are being pitched these kind of things. We gotta let them know, the law changed. Okay, all right. All right, fiduciary taxation. So let's talk about that. So trusts and estates, they're separate taxpayers, right? They file a separate tax form, and there's no double taxation. So the income doesn't get taxed twice, unlike a C corporation, right? So there's no double taxation. And similar to pastoral entities, you get conduit approach for the income, and the tax rules are very similar to individuals, very similar. So let's talk about fiduciary accounting. That's really important that we need to deal with first. So fiduciary accounting, we have two concepts, income and principal. Income and principal. So income is current return from a principal asset. If a rental property is paying me rent. If I have money in the bank, it's paying me interest. If I have money in a mutual fund, a stock, it's paying me dividends. That's income coming from an asset. Principal, property held in trust for the beneficiary when the trust terminates. And so, it could be the money, the property, the investments or whatever. Capital gain distributions are considered to be principal. Any sales of property, the gain is principal, and life insurance proceeds. So, so that's important to understand the difference between income and principal. All right. So reductions on income and principal. So for income, you've got ordinary expenses. Now, when it comes to a trustee, you allocate half to income, half to principal. Half of whatever the trustee fee, you split it in half between income and principal. And then income tax payable on income, that reduces the income, and depreciation. For principal payments on debts, if there are any debts, right, that reduces their principal, half of the trustee fee, and tax based on receipts allocate to principal. So tax specifically related to principal gets charged towards principal, and same thing with depreciation there. All right, so taxable income and tax liability. So tax returns are potentially required. So, for an individual, we filed the 1040 until the date of death, until the date of death. And then the 1041 kicks in, either a trust or an estate, after the date of death. It could, if it's an estate or a trust electing to be an estate, could be a fiscal year, but in general, they're calendar years. There could be a 706, an estate tax return. Now, what kind of 706s are we filing now? Well, unless you're lucky enough to have clients with large estates, like in 25, it's 13,990,000. If you have more than that, yay, that's good for you. But for many of our clients, they're a married couple, right? They're a married couple. The first spouse dies. They might not have a taxable estate because, let's say they have 5 million or 10 million, way below the basic exclusion amount. But why are we filing a 706? To take advantage of portability of the deceased spouse unused exemption. So, for example, you have a married couple, they've got about $10 million of assets. Husband dies. And so we file 706. And because the wife is also a U.S. citizen, um, they can take advantage of the unlimited marital deduction. So we don't use any of his exemption. So what that means is we can take his unused exemption, 13,990,000 for 2025, add that to hers. And then, if her estate grows to a lot more, we still have his unused exemption. You know, it's a good question, right? Do we do it for every client? Probably not. For our clients with small estates, we're probably not going to do it for them. For clients with larger estates, we have no idea what the future tax laws are going to be, right? It could drop. So I don't know. We don't know. So it's kind of a bit of an insurance policy. But it's important to talk to our clients about portability when you have a married couple where the first spouse dies. The best way to claim it is, of course, on a timely filed return, which is due 9 months after death or plus a 6-month extension. But the IRS has given us some relief that you can do it within 5 years of death. But, better to do it on time. Polling number 3 is up. I think this is a good time for a break so I can take a look at the Q&A here. Maybe there's some good Q&As. Um, so while you guys work on this polling question, I'm going to take a look at this Q&As. And some of these, if it's easy, I'm going to answer those first. All right. All right. Mary's got a question. Can you elect a fiscal year even if the return was put on extension based on a calendar year? Yes, you can. As long as you qualify to file a fiscal year, yeah, it doesn't matter what you put on the extension form because you make the election when you file the first 1041. So that's when you make the election. All right, so that's been answered. Okay, Beverly, if trust document says charities to get a percentage of the assets instead of stating percentage amount, is that a qualified deduction on the 1041? Yes, if it's stated in the trust. I have to admit to you, I don't know about you guys, how you feel about that. I just went through this recently, and boy, there's some charities there that has an army of lawyers. And now I've learned from the experience. I'm here in California. I'm in Silicon Valley. I'm right next to Stanford University. So if you name Stanford University as your charitable beneficiary, you get an army of lawyers descending on you because they want you to do the accounting to the penny. Because when you say they get 30%, they want to make sure they get the 30%. So my tip to my clients is if you don't want the army of lawyers for your beneficiaries to deal with, put a dollar amount, and the question is, well, Larry, what if I don't have the money? Well, you can say that if I don't have the money to give to them, then there's no gift, or something like that. But or put a dollar amount that you'll have the money to give to the charity. Like Stanford would get $10,000. Well, that's what it says. You give them a copy of the trust. It says $10,000. You deduct $10,000. No army of lawyers. So I don't know. Same thing with people, right? Beneficiaries. There's always that contentious family member who's going to hire an army of lawyers. Maybe just give them a dollar. I don't know. That's just my personal opinion. I just been through that stress, and I frankly don't enjoy it as a tax professional. I don't know how you guys feel about that. Uh, Michael's got a question. In the case of business assets in an irrevocable trust, there would be no step-up in basis, correct? Oh, yeah, we just mentioned that, right? We got that revenue ruling that says that if you put assets in irrevocable trust and it's a gift, right? You file 709 gift tax return, you took it out of your estate. It's not yours anymore. There's no step-up in basis. That's right. Yeah, we gotta question the wisdom of putting business assets into an irrevocable trust. Ooh, I've got concerns about that. Must you use a 1041 form for a grantor trust or can it be reported directly on a 1040? Georgina, that's a really good question because in the tax community, I've heard some various opinions on that, right? Personally, technically, no, you're right. If it's a grantor trust, you don't necessarily have to file a 1041. Just report it on the 1040. But it's going to confuse the IRS, right? What's on the 1099? It's going to be the FEIN number of the trust. And then the IRS is going to send us. Yes, I have seen CP 2000 notices for trusts. So I don't like to confuse the IRS. So I'd rather do the 1041, check that box and you get those words in the middle of the form. And then your software will generate that letter that you put the information on the 1040. I just find that a whole lot easier. So, because, you know, client gets a CP 2000. What's the first question they're going to say? What did you do wrong? So I don't like that. Let's see. Oh, I think we're doing pretty good here. I think I'm going to stop here for now. I'm going to stop here for now with the Q&A. I'm going to move on here, and I'll pick up on the Q&A a little later. Okay? Good questions. Keep them coming. Keep them coming. Okay, let's talk about gross income. So trust and state gross incomes, just like the individual, right? Just like the 1040, gross income for tax. This is the big mistake people make. Gross income for tax is not the same as fiduciary income, fiduciary accounting. They're different, right? So not the same. We'll go over that in a second. Simple trust, distribution deductions. That's that Schedule B. Simple trust, all income must be distributed. The distribution deductions limited by the distributable net income. Income's not offset by deductions. In a simple trust, there's no deductions per se because all the income's being distributed. Complex trust. Complex trust can accumulate income for whatever reason, right? You know, um, the trust is generating, well, in this drug addict's case, what's 12 times 40? It's 40,000 a month of income. You don't want to give her $40,000 a month. I think trustee was giving her like 10,000 a month, and that was still going to drugs. But so yeah, the trust is paying taxes. They know that the purpose of the trust is not to save taxes. Um, Also, I think her income would have been the top tax bracket anyway, so it probably didn't really matter. So if your beneficiary is going to be in the same tax bracket, you know, and the trust is paying the 37% tax, it's probably not going to make a difference in that case, right? Now, if there's a big discrepancy in tax rates, that's a different story. All right. So what's the distribution deduction for a complex trust? It's going to be the required distribution. The trust document might say, hey, 2000 a month, 2000 a year or whatever, plus discretionary payments. So the trustee decides to pay, to buy a car or down payment for a house or something like that. Just like a simple trust, distribution deductions limited to distributable net income. So, if you distribute a lot, but it's more than distributable net income, it's not going to be um, more than that. And of course, a complex trust, you can pay out of principal. If there's not enough income, you can pay out of principal. All right. On the front page of return, we have those exemption deductions, right? So, and the state or trust does not receive an exemption in the year of termination, so that's going to be blank. That's going to be 0 in the year of termination. We check the box that's final. So for estates, it's $600 per year exemption, and for trusts, it's $300 a year if all income's distributed annually. So that could be a simple trust, right? It's $300 exemption. It's $100 a year if no requirement for annual distribution. So that's most likely our complex trust. That's $100, $300, or $600. Not a big number, so I don't really pay a whole lot of attention to it, but hopefully your software pops in the right number on the line. Okay, Schedule A. We took a look at Schedule A earlier from the forum. So this does not apply to simple trusts. There is no charitable deduction for simple trusts. But under the terms of the will or governing instrument is paid or treated as paid during the tax year for charitable purposes. And it's just like as an individual, the types of charities that would qualify under Section 170C. But For a trust, it doesn't have to be, not necessarily that the charitable organization be created or organized in the U.S. It could be an overseas charity. There's some due diligence you need to do with that. Generally, the corollary is if the charity, if it were in the U.S., if it were operated in the U.S., it would be a charity, not a problem. But if it doesn't meet those standards, that could be a problem. Election to treat contributions paid in the prior year, uh, in cases where income's earned in the prior year but paid in the current year, you treat as paid in the prior year. So it's going to get a little bit of matching there if that's a situation, right? Boom, we got a bunch of income, but we didn't get around to paying it until this year. So we can make the election to deduct it on the previous year. This is when you file an extension to be able to have some more time to figure that out. All right. Schedule B, income distribution. So line 8. So we got accounting income. It's not used for decedent's estate or a simple trust, but for a complex trust, income for the year determined under terms of the governing instrument and applicable local law. Do not include extraordinary dividends or taxable stock dividends. Stock dividends are allocable to principal, to corpus. And yeah, that doesn't happen too often, but if that does, that's something to consider there. Or there could be some tax credits. Whoops. Tax credits. So same rules as individuals when it comes to credits and their limitations and all that. Again, hopefully we don't have a lot of that. Foreign tax credits, limit to foreign taxes not allocable to beneficiaries. All right, let's talk about distributable net income. What is distributable net income? DNI. Oh, polling number 4 is up. Please click away. Please click away. DNI. It sets a ceiling on the amount taxed to beneficiaries. So the beneficiaries are taxed on the lesser of the amount of distributions received or their share of the distributable net income reduced by any net tax exempt income. If there's any municipal bonds or whatever in there. Distributable net income determines the character of the beneficiary's income. And we'll go over an example of that. So the excess of gains over losses are credited to principal because that's capital, right? Less the personal exemption. And for a simple trust, that's income. That's income for a simple trust. So when you have capital gains, it's not the last year that the trust is going to be paying taxes on the capital gains. All right, to calculate DNI, how do we calculate DNI? You start with taxable income. So you start taxable income, then you add distribution deduction, personal exemption, net taxes and interest, deductible capital losses. So you add that to taxable income. And then you subtract any capital gains and extraordinary dividends and taxable stock dividends allocable to corporates for a simple trust. So let's go over an example here. So in this case, we have dividends of $5,000, long-term capital gains of $10,000, tax-exempt interest of $3,000, and expenses of $3,000. So those are our facts for this trust. So first we start with what's a trust accounting income, TAI, trust accounting income. So we take the 5,000 trust accounting, right? 5,000 for dividends, not the long-term capital gain because that's allocable to principal, to corpus, right? Tax exempt interest, even though it's not taxable, but that still gets included for tax accounting income. And then we get expenses. Expenses are, could be trustee fees, let's say. So half is towards principal, half is towards income. So we take half of that. So our trust accounting income in this example is $6,000. Then the next column is distributable net income. Distributable net income, what income is distributable to the beneficiary? So dividends 5,000, taxes and interest 3,000. But we had the whole full expenses there. So total distributable net income is $4,000. So that's the most our beneficiary could pay taxes on. And then TI is taxable income. That's what you pay taxes on, right? So we pay tax on the $5,000 of dividends, $10,000 of long-term capital gain, $4,000 expenses. So the total taxable income is $11,000 in this example. So in this example here, the beneficiary is going to be paying taxes on $4,000 because that's his distributable net income. And then the difference between that and taxable income is $7,000. Yeah, 11 minus 4 is $7,000. That's what the trust pays taxes on the long-term capital gain. So here's my little cheat sheet that helps me remember what these mean, right? Trust accounting income, TAI. Who gets what? Distributable net income. Who pays the tax? And then taxable income, what is subject to tax? So, I like to print this out and hang it on my wall because I can't remember this, but this is pretty good of remembering how this works. So let's go back here. So first one is TAI, trust accounting income. Who gets what? And then the next one is distributable net income. Who pays the tax? And then TI is what is subject to tax. So I think this is a nice handy guide to remember this. Okay, so for simple trust, all accounting income must be distributed currently. And the distribution deduction equals the accounting income. The exceptions are distribution deduction cannot be more than DNI, and no distribution deduction for net taxes and income contained in DNI. Okay, what if you have a net operating loss? That could be the case, right? NOLs do not pass through the beneficiaries unless the loss arises in the year the trust terminates. You don't get that while the trust is still alive. And so that gets applied against other income and all that. But as a beneficiary, not until the trust terminates. Boom, then you get the NOL. Depending on the law, you know, um, trust can carry back and forward NOL if the law allows, but we don't have carrybacks right now. We can only carry forward. It's an indefinite carry forward. And if you terminate the trust, if there's any NOLs left over, it goes to the beneficiary. Capital losses, just like individuals, right? The maximum capital loss deduction is lesser the $3,000 limit or in excess of capital losses over capital gains. So if we got more than a $3,000 capital loss, you can only claim a $3,000 loss. Okay, so for simple trusts, so taxable income is DNI minus distribution deduction, expenses, and personal exemption. So in general, most our simple trusts are not going to be paying taxes. Most of them are not because the beneficiaries are. So here's an example here. So we got interest and dividend income is $20,000. We paid the trustee $2,000. We paid an investment advisor $6,000. We paid $1,000 to repair the tax return. And the trust owns the house, and so property taxes on the residence owned by the trust is $11,000. Okay, so DNI is the income tax either the entity or the beneficiary. If income's accumulated and not deemed distributed, it's taxed to the trust or the estate. So if the money stays in the trust has got to pay taxes on it. If income's distributed, the trust gets a deduction for the distribution, limited to distributable net income. So beneficiary accounts for income distributed on his own return. It shows up it flows to their K1. K1 flows to 1040, and it's limited DNI. So here's a handy dandy spreadsheet to help us with this here. So yeah, we had $2,000 of interest, $18,000 of dividend. That's the 20,000 there. And we had disbursements, real property taxes, tax preparation, trustee fees, investment advisor, and so trust accounting income. The first column there, we got the 2,000, 18,000, 20,000 real property taxes, tax preparation, trustee fees. Let's see. Tax preparation is 500, trustee fees 1,000, 3,000. So the trust accounting income is $4,500. Next column is taxable income. What's taxable? We got to pay taxes on the interest and dividends here. Property taxes. Thank you, TCJA. Yeah, we paid $11,000 in real property taxes, but it's subject to the SALT limitation, so we can only deduct $10,000, even though we paid 11. Let's see, tax prep. So we've got 1,000 there. Uh, let's see, trustee fees, the 2,000. So we have 7,000. So 20 minus 13, $7,000 of taxable income. And then for distributable net income, we got the property taxes, tax preparation, trustee fees. Um, it's 13,000, so it's also $7,000. Now we got a filled in 1041 here to show how this shows up on the tax return. How does this show up on a tax return? So this is kind of hard to read, so we blow it up here. So if you look at line 1, that's the $2,000 of interest income. Line 2A is the ordinary dividends. So line 9, total income is $20,000. In this example, it's a simple trust. So in box A, we check the box that's a simple trust. Simple trust. Let's see here. Okay, so on the deduction side here, we got the taxes, limit to $10,000, thanks to the SALT limitation, fiduciary fees. Let's see, line 14, tax prep fees. So line 16, the total deductions. And then so line 17 is 20 minus 13,000. That's $7,000. That's our adjusted total income or loss. So line 18 is $7,000. That's our income distribution deduction. We'll look at Schedule B next. So there's no tax here. We get the $300 exemption. No tax due in this case. Then we go to Schedule B. So page 2 is Schedule B. So Schedule B, income distribution deduction. So line 1 is adjusted total income. And because this is a simple trust, we don't have any adjustments on lines 2 to 6. So line 7 is distributable net income. Line 9 is income required to be distributed currently. And then line 15, income distribution deduction, $7,000. That flowed to page 1, so the trust does not pay any taxes. Let's see, page 3, I don't think there's anything surprising here. I think we answered no to all these questions. Schedule G is blank, there's 0 there. But here's the K1 for the beneficiary for this simple trust. So, so line 1 is $700 for interest. Line 2, 2A and 2B is $6,300. 700 plus 6,300, that's our $7,000 of DNI, right? So that's, even though we have $20,000 of interest and dividends, but the beneficiary in this case is only paying tax on $7,000. All right. Okay, so that's an example of a simple trust. So let's move on here and say this is a complex trust. This is a complex trust. Same facts, same numbers, except the trustee has discretion, right? Has discretion. And he only gave $2,000 to the beneficiary. $2,000 went to the beneficiary. So now it's a complex trust. It's no longer a simple trust. So in the complex trust here, we check the box in box A that it's a complex trust. So on the income, it's the same, no difference there. And the deductions, no change there. That's the same. What line 17, adjusted total income, that's a $7,000. However, box 18, income distribution deduction is only $2,000. Why? That's all the trustee gave to the beneficiary is $2,000. So, so we have a $100 exemption. So the deductions are $2,100. So the taxable income is $4,900. And in this case here, the trust has to pay income tax of $302 because not all the income got distributed. The trust has to pay some tax in this example here. So Schedule B, right? Schedule B, the adjusted total income is the same, $7,000. Line 10, amounts paid. The amounts paid was $2,000. So because only $2,000 was distributed, that's our distribution deduction. Schedule G is the tax calculation. So we have tax on taxable income. Oh, yeah. Line 5, we have the net investment income tax. Thank you very much. So add the surcharge. So 285 plus 17 is 302. Income tax plus the surcharge. Yep, and that's not going away, is it? Okay, and then the K1 here. So look at the beneficiary has to pay taxes on $200 for interest income, $1,800 for dividends. That's $2,000 because he only got $2,000, so he's only paying tax on $2,000. So the beneficiary is not going to pay tax on an income he didn't get. All right, so how was that? Was that helpful? Why don't you go ahead and do another polling? I'm going to take a look at the Q&A here because I think I saw some questions pop up. So let me continue on the Q&A. All right. So you can pop up a polling question if you want while I look at the polling here. Okay, Linda. Okay, Linda's got a question here. Is a marital trust considered to be a revocable trust since the beneficiary is entitled to all income and principal as needed for health, support, and care? And what's that called? Oh, yeah, polling number 5 is up. Please click away. What's that? HEMS? HEMS, right? HEMS standards, health, education, maintenance, and all that. And boy, is that subject to debate. So, Linda, I'm not sure. Uh, uh, because lawyers call trust all kinds of names, and that's what we need to read the trust document to see what is going on. They name trusts all kinds of crazy names. One lawyer might call it this, one lawyer might call it that, and they're totally different trusts, or it could be the same trust. So if it's a marital trust, usually a marital trust arises after the death of the first spouse. So in general, um, usually the estate gets split, right? Half belongs to the spouse, half belongs to the decedent, and again, depending on operations of the trust. So the surviving spouse can still have her assets. His assets might go into a marital trust, which might be a irrevocable trust, not a revocable trust. A revocable trust is your living trust. That's when both spouses are alive. And if it's a revocable trust, you can basically do anything you want, because the trust is not doesn't really exist until you die. It doesn't become irrevocable until you die. All right, James, let's take a look at James's question. You got a lot of words here. Let's see what I can read. I have an irrevocable grantor trust with 4 rental properties. Took over in 2024 from prior tax prep. The grandparents passed to the parents, and the basis was not stepped up. They also did the rental properties on the trust Schedule E and took bottom line over to 1040. Corrected a form 3115, put rentals into 40. Moving forward, does this seem okay in theory? James, this is a good question. I guess it depends on what the trust agreement is. So, from what I can understand, what you're telling me here is that the grandparents set up this trust, and then they died, and then went into an irrevocable trust for the for the benefit of the parents. Yes, there would be a step up in basis upon the creation of the trust because it was created upon death. So we get a step up in basis there. And the question is, does this trust continue to hold the rental properties, or do the rental properties get distributed to the parents in your fact pattern here? So that's a good question, right? So it depends on what the facts are there. All right, Marguerite. Ooh, can you deduct financial advisor fees on 1041? Yes, you can. Yes, you can, because we got to pay them, right? All right, let's see. Kenneth, some clarification for 2023-2 revenue ruling. There are many irrevocable grantor trusts that include the primary residence that the taxpayers pay all the taxes, continue to live in, and receives all the income from the trust and can swap property in the trust. Does the house receive a step-on basis? Does the Section 121 apply when the house is hold since their taxpayers make there's a lot of debate there, but in general, once a trust, an irrevocable trust owns the home, it's not your home anymore. So Section 121 applies to you. the human being who owns the property. Section 121 doesn't apply to trusts or partnerships or LLCs or any other entities. So that could be an issue there, right? So, and there's no step-up basis. That's what 2023-2 tells us there, because you made a gift, made a gift. So yeah, we just got to be really careful about what our clients are trying to accomplish there, and kind of help them understand what they did. All right, the date the trust is created. Oops. Uh, the date the trust is created in the heading, is that the date the trust was formed and the date, or the date it was funded? Um, I usually put the date that's funded because a lot of times our clients do the living trust 1992, but the trust, the return that we're required to do didn't spring up until 2025 or whatever that is. And why would I do that? Well, because I don't want the IRS to start poking around and say, hey, where's that 1995 tax return or whatever, right? Okay, why is there no rental income when you're showing property taxes? Oh, this example here, I made up the facts, all right? I didn't want to make it too complicated. So, no, I didn't have rental income. It's holding the house. Okay. All right. Please explain the adjustments on the simple trust example. Okay, we'll go back to that. If the IRS is silent on the question, the trust needs to fall back to state law to resolve disputes. Yeah, yeah. So if the trust is not well written, not really clear, we got to go to state law. Okay. With the spend, oops. With the spend trust that has rental property, if income is distributed to the beneficiary is noted on the K1, does the trust pay all the taxes because it's a spend trust? I don't know what you mean by spend trust. I guess you mean spendthrift trust. A spendthrift trust is a trust that kind of manages the money for the beneficiary because if you give them all the money, they're just going to blow it. So there's a certain restriction on how much gets distributed. Um, yeah, there's some interesting things about the financial advisor fees. So if I don't have the words in front of me. Oh, I think that's in my next slide. Stephen, hold your thought there. And let's see. Let me go back to that spreadsheet. So, okay, I think we answered most of the questions, right? Okay, good. All right, let's go back to that spreadsheet there. All right. Where's the spreadsheet? Ah, here's simple trust example. Okay. All right. So let's see here. So the first column, the actual columns are what the actual numbers are, what the income, what the expenses are. Um, Let's see here. Okay, so when it comes to tax trust accounting income, there's a 50-50 allocation between income and principal. So that's why if you look at tax preparation, um, half goes to income, half goes to principal. Trustee fees, half goes to income, half goes to principal. Investment advisor, half goes to income, half goes to principal. For tax deduction purposes, we got to deduct the whole thing. We got to deduct the whole thing, um, and that's what we're doing here. So that's what the adjustments are from tax accounting income to taxable income. All right. Okay, so that's what the reasoning behind that spreadsheet is. Okay, here we go. All right, so so we went through our sample, which was really helpful to me. Okay, deductions, the 2% limitation, 2% of AGI limitation. Expenses which will be subject to the 2% AGI floor for individuals are also subject to the 2% AGI floor for trusts and estates. The exceptions are expenses incurred during administration and which would not have been occurred if the property were not held in the trust. So we had some final regulations to Section 67 deductions. So, according to the regulations in Section 67, it says administrative costs are above the line. Exemption and distribution deductions are above the line. So Section 67E deductions are not itemized and disallowed under 67G. 67G is the TCJA, right? And 67B deductions are itemized deductions subject to 67G. So take a look at those and all that because so when it comes to the fees and all that, we're taking above the line. All right. So Section 642H allocation and excess deductions. That's only applies upon termination of the trust, not while the trust is still alive. So deductions are allocated first to the related class of income. Remaining deductions are allocated to remaining income. Excess deductions are divided into categories defined under Section 67. So some items do not transfer to the beneficiary. So investment interest expense carryover, that's 4952. Foreign tax credit carryover or passive loss carryover, it creates basis instead. So, so that's the way the deductions work. And, you know, it depends on how the trust is written too, on how long the trust is going to be around. Could it be around forever? Could it be around for a couple of years? It all depends. So we have the tier system of allocating distributions deduction. So tier one is beneficiaries with mandatory distributions. So the trust agreement would say you got to give this guy $2,000 a month. Those are mandatory distributions. Line 9, Schedule B on page 2 of the 1041. First, to absorb income, and income is taxed on lesser of distributable net income or the aggregate mandatory distributions. That's for tier one. So tier two is any beneficiary who is not tier one, line 10 of Schedule B. So it's your required distributions plus all other payments. You know, as a trustee, oh, he needs to buy a car, I'll give him 10,000 bucks or whatever. And if it's more than DNI, then the tier two income equals the distributable net income less income required to be currently distributed times this ratio. Income required to be paid or distributed to this beneficiary over aggregate of amounts paid or required to be distributed to all beneficiaries. So we got the separate share rule exception. Beneficiaries can report gross income if it's less than distributions received. Um, so if you have specific bequests, so even if bequest is made from principal, the beneficiary may still need to report it in gross income. If it happens to be coming from principal, that's if the beneficiary's gross income cannot be more than DNI. So DNI gives us the ceiling of what's taxable to the beneficiary. So complex trust, effective NOL. NOLs of a complex trust can be carried forward indefinitely. NOL limited to 80% taxable income in the years carried forward. Remaining NOL passes to beneficiaries in the year the trust terminates. So if it terminates, boom, that's when it gets allocated to the beneficiary. I think we complex trust. Oh, capital loss. Same as simple trust. So complex trust ability to retain income means that there may be more ability to absorb NOLs for complex trusts. So what other forms we need to be considered here? Form 56. That's a super important form. That's a notice concerning fiduciary relationship. You notify the IRS of the creation or termination of a fiduciary relationship. Why do you need to file this form? What happens to your 2848 or 8821? The 2848 is the power of attorney. The 8821 is the income disclosure. What happens to that when your client dies? Yeah, it dies of your client. Boom. So you call practitioner hotline and say, hey, can you help me out here? IRS is going to say, sorry, can't help you out because the power of attorney has expired because your client expired. Um, so Form 56. So I usually work with the trustee. I'm dealing with one right now. It's an interesting situation. As for he's an interesting character. I haven't heard from him for 5 years. You know, the last tax return I did for him was 2019. Then haven't heard from him. He's that kind of guy, you know. Well, I find out he died. I find out he died, and we don't know if he did his taxes. Probably not. But I can't go to e-services and download the transcripts. We'll have to have the trustee file Form 56 and also fill out Form 4506, 4506, right? 4506T to get transcripts. I kind of know what his income is and all that, but we just want to double check, right? So, excuse me. Yeah, so 456 is very important. Okay, Form 706, we talked about this a little bit here. Estate tax return, you know. I'd be I think you can hit the react button, I think. Do you have a react button? I don't see one here, but excuse me. The react button's where you can, make emojis fly in the webinar. I don't know if you have you don't have to tell me. It's an anonymous way of letting me know. Do you have clients who have more than $15 million, right? So most of us don't. Some of you might. But most important reason we file a 706 is portability of the deceased spouse and use exemption. That's a whole other class in itself. There seems to be an argument in the tax world here about, how precise you need to be on that form. I don't know. I highly recommend getting an appraisal for the date of death to get the value of the property, not Zillow, not the friendly realtor. Get a real appraiser. Don't be cheap. Buy an appraisal. Why is it important? Well, that helps me establish what the basis is. The basis is, and then I think another tax professional I kind of got in an argument with was that she said, "Oh, you have to file Form 8917." I don't have it listed here. What's 8917? That's the basis consistency form. So, hey, if I report $1 million for this house on the 706, my basis is $1 million for the beneficiary. I guess some people were kind of fudging the numbers where they were using different numbers for inherited property than what's on the 706. And, it's kind of hard for the IRS to catch. The thing is, according to the instructions to that basis consistency form, you have to file it if you have to file the 706. So if you're doing for portability, I'm not going to do it. And also, if you look at the form, you have to let all the other beneficiaries know what everybody else got, and I just don't want to start that fight. Okay, so we'll do it for the deceased spouse and use exemption. I highly recommend getting appraisals. Um, polling number 6 is up. Polling number 6 is up. All right. Form 709, U.S. gift tax returns. Why is that important? Well, if you don't file a gift tax return and your client made a gift, but you never filed the return, there is no statute of limitations. It never started because you haven't filed the form. Um, Personally, firsthand, I've only had one 709 audited. Yeah, ooh, that was more like 15 years ago, maybe before TCJA. Before TCJA, because it was a taxable gift because we had a low exemption there, and I think it was a training audit for the IRS agent because he was going through his questionnaire asking all kinds of questions. The gift was a client who gifted her house in San Francisco to her daughter. That was it. Pretty straightforward. Um, we had an appraisal and all that. So I thought it was pretty low risk, low issues there. But I think it was a training audit. That's the only one I've had. So maybe your gift tax return won't be audited. It will be audited if you don't have adequate disclosure. A few years ago, we had some regulations about adequate disclosure because if you don't have adequate disclosure, the statute of limitations has never started. So don't make up a number or you submit a gift return like this client who gave a house to her daughter. Well, attach the appraisal. That gives adequate disclosure. And there's some more rules about that. So it's important. When will this audit happen? It's when you file the 706 for the surviving spouse. So there could be an audit of the portability return from the death of the first spouse. There could be an audit of the gift tax return if it didn't have full adequate disclosure. My office mate had a case where he did the 706 for his client, and he said he didn't make any gifts, right? Are you sure? No, no, he never made any gifts. No, he never made any gifts. So he did the 706 without reporting any gifts. Well, guess what? He did. And the family should have known because he gifted houses to the family members. The son got a house, the daughter got a house. It's obviously more than the annual exclusion amount. Today it's 19,000. That should have been reported. And it was reported. So I guess they forgot about it. So the IRS had to adjust the 706 for those gifts that were not reported on the 706, and the family owed a whole bunch more money on the estate return. So that's the risk there. So how do you protect yourself when you're doing a 706? And you ask the family, and they say, "Oh no, we never made a gift." File a form 4506, the what do you call it, transcript form, and check the box for form 709. So at least you'll know what the IRS knows. And is it perfect? No, it's not perfect, but at least you won't embarrass yourself by not reporting something that the IRS knows about. So just some practical tips. I hope that's helpful. Okay, so we finished polling number 6. All right. The next issue is state taxes. Oh, yeah. That gets confusing, right? That gets confusing. State tax consideration. So, when will a trust be subject to state fiduciary income taxation? You know, what's the residency of the grantor? What's the residency of the beneficiary? What's the residency of the trustee? Where are the trust offices, right? So this can get quite confusing. Or where's the property located? If it's real estate, is it in South Carolina? Is it in Florida? Or is it in Texas? Or where is it? Is it in New Jersey? Some really interesting cases on these state issues. But we had a Supreme Court case a few years ago, the Kasner case, and I think in that case, I think it was a North Carolina case. And the trustee lives somewhere else, but the beneficiaries are in North Carolina. So there was an issue about who's got to pay taxes on where and which state. And of course, the states are going to try to grab what they can. So, in the Supreme Court case, in the Kastner case, in that case, the residence of the beneficiaries determined residency. And so that applies to trusts in California, Georgia, North Carolina, and North Dakota. But I would be super careful. So in your notes, I would make notes on, oh, who's the grantor? Oh, he's a New York resident. Okay, good. That's good. Where's the property? Well, it's in Illinois. Oh, okay. All right. And where are the beneficiaries? So it's kind of good to map that out. Now it gets a lot more confusing, and I had to deal with this a few times recently. Is the beneficiaries are not in the U.S. Oh no. I had a case where beneficiaries are in Canada. Oh boy, you got some issues to deal with there. The really interesting one was where the beneficiaries are in China. They're in China, in the village. And so they didn't have any English names. It was only in Chinese, and that got a bit complicated. Oh, that got kind of interesting. And you couldn't write a check to them. You can't just write a check out of the checkbook and here's your money. Had to go through a third party or something like that. So that could be quite interesting, right? So you have to ask your clients, who's the beneficiary? Where are they? Where's their property? What property? And those kind of issues. So state tax considerations. I know some clients are trying to be really clever and try to say, I don't want to pay taxes in California because you guys have high taxes. Well, if everything's here in California, you're going to be paying California tax. If you don't want to pay California tax, get out of California. Don't own any property in California. No residences or whatever. So it depends on the state. All right, we're getting towards the end here. So let's talk about best practices when we're dealing with this, right? Number one, read the trust agreement. Client comes up, and I know I'm not a lawyer. You're probably not a lawyer either, but that's okay. Read the trust agreement. I think I'm above average intelligence, I think. Maybe average intelligence. But I've got a pad of paper next to me when I'm reading the trust. I'll take notes, and the next slide, I'll talk about how to read the trust, but I'll take notes on it. I'll make a list of questions, maybe put post-its on those pages. I find it a lot easier to print it out and do that versus trying to read on my computer screen. I'll probably miss things that way. Read the trust agreement. Read the decedent's will. What does the will say? Because a lot of times the will covers things that are not in the trust, such as personal property and those kind of things. That spreadsheet I had, prepare the accounting income spreadsheet outside your tax software. I don't trust the tax software. It's a good check to your tax software. So I highly recommend doing the spreadsheet. Start with the trust accounting income, distributable net income, and taxable income. So at least you'll know, you can read the trust, read the Schedule B, and see, does that look right to you, right? And preferably tax plan before the year end. So I've gotten calls from prospective clients, and they'll say, "Hey, can you do my trust return?" I said, sure, but I need to do your 1040 too. No, no, I only want you to do a trust return. I'll do the 1040 on my own. No, 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 no. So, and then they don't become a client because they're too cheap. So I don't know. Anyway, so let's talk about how to read a trust. How to read a trust. So you wanna key in the key terms of a trust. You get a trust document here. Now, here's a little secret. I think you already know the secret that lawyers, they don't write trusts from ground zero, right? They it's just like us. They have software, right? So the software has templates, and then they check boxes here to include this term or that term or whatever. Sometimes they'll use the most recent Word file, and I read it and I go, "You have a daughter named Sally? I didn't know that." No, I don't have a daughter named Sally. Well, that's what it says here in your trust. You have a daughter named Sally. I don't have a daughter named Sally. Well, there's probably a boo-boo in your trust here. Some girl named Sally is going to get your money. Okay. Um, so, key terms. Who's the grantor? Who's the trustor? Who created the trust, right? That's very important. Where's this money coming from? Who's the trustee? Who's responsible for administering the trust? My first question, is your trustee still alive? Because a lot of our older clients, who they name as trustees? Their buddies. Well, their buddies are 95 years old too. So do I really want that? And for some clients, I think as a profession, there's a private fiduciary profession out there. Maybe you're a tax person, you're tired of doing taxes, yeah, you're really organized, and you're good at dealing with family drama. Be a private fiduciary, and you can make some pretty good money at that. Um, so some clients I recommend that where, yeah, you can have the family member has a family connection, but your co-trustee is a professional. That person knows how to administer the trust. And also, if there are any complaints from the beneficiary, they can yell at him, right? I mean, I know we have different choices of trustees. It could be a family member, it could be a private fiduciary, it could be an individual who has a practice of administering trusts, or it could be an institution. There are trust companies out there. There's banks, right? And they all vary in how they charge and what assets they'll deal with, what assets they won't deal with. Some won't deal with real estate. Some won't deal with cryptocurrency. Some will deal with cryptocurrency. Yeah, so it depends on what assets we have too, because that fiduciary can be able to handle it, right? Would they understand how to deal with cryptocurrency? If they don't, do they have a colleague or someone in their team that can help them with that? Um, I get uncomfortable when you have siblings and you got one sibling in charge of it, and you know what happens, right? They all end up fighting, and it's just no fun. And I've had people come to my office where they start yelling at me. It's like, oh, I'm just the tax guy here. Why are you yelling at me for? You know, um, there's always you start learning about all the crazy people and people's families. I've had my share. I've had a few where they refused to give me their social security number, and I told the trustee, don't give them any money. Don't give them any money until they give you the social security number, because if you give them money, you lost your leverage. We'll never get the social security number. Oh, that's no fun, right? We need a social security number for the 1041. Otherwise, it'll be rejected. Okay. Um, polling number 7 is up. Okay, trustee. Who's the current beneficiary? Current beneficiaries, who's getting income from the trust now? If it's a revocable living trust, most of our living trusts, right? The grantor, the trustor is the current beneficiary because it's I put my assets in a living trust, I get my income from it. That's the current beneficiary. Or you have a trust where someone died and this trust springs up because someone died, or someone set up this trust. There is a current beneficiary, but there could be a remainder beneficiary. That's gonna be the beneficiary who gets the distributions after the death of the current beneficiary. So it could be the current beneficiary could be the surviving spouse, and then the remainder beneficiary could be the children, or it could be the children and then the grandchildren or whatever, right? So we want that named. Sometimes, this happened to a client where grandma, she named the beneficiaries. Good job. Guess what? She got like 4 more grandkids, and the trust only named the original grandkids, and then she died. Ah man, the 4 new grandkids got nothing. I would have sued the lawyer because the lawyer could simply add a sentence saying, these are my grandchildren. Plus, any new grandchildren or grandchildren to be born or whatever, something like that, right? So yeah, that family. Ooh. So you're the outsider. You're not part of the family. You're not picking sides, but you can raise your hand and say, "Hello, what if there's new grandkids? What about them?" Right? Okay, and then let's next here. Um, let's see, did I skip a page? Okay, we got that. Testamentary power of appointment. It's a power granted to a beneficiary to deduct how the remaining assets of the trust will be distributed on the death of the beneficiary. Do I have control? I'm the beneficiary right now. I'm the current beneficiary, but do I have testamentary power of appointment? I can say, yeah, it's going to go to my kids, or it's going to go to my grandkids, or whatever, right? Issue, what's the issue? Lineal descendants of a person, the kids. Per stirpes, that's Latin for by branch. So per stirpes, so if a child predeceased her parent, her share would be divided into equal shares for her descendants, right? So, and state law, right? State law can dictate whichever things to go. And do you ever agree with state law? And there's that confusing table of sanguinity when it comes to those kind of things. So we see it, we see a lot of the celebrity cases, right? Was it Aretha Franklin? Was it Prince? Aretha Franklin, her will was found in a couch cushion, and the court said that's the real will. And then for Prince, all these people start popping up. He's my dad. So, it gets kind of interesting here. So, don't follow what celebrities do. That's why we read about all those interesting soap operas. Okay, more terms in the trust. Income, the return in money or property received from the use of principal. Sometimes you want it in the trust document so you don't have default to state law because you might not agree to state law. Principal or corporates, property set aside for eventual delivery to one or more remainder beneficiaries. Definition, I don't know, do we have a later law? This is the Uniform Principal and Income Act that was in 2020 or the Uniform Fiduciary Income and Principal Act of 2018. There's a new law that I put in here, start with the letter R, REDUFA. That's for digital assets. Yeah, that's new, right? Digital assets. What are digital assets? That could be cryptocurrency, NFTs. It could be your Facebook account and those kind of things. So you got that. Revocable. A trust that allows the creator to change or revoke certain terms of the trust during the creator's lifetime. It becomes irrevocable upon at death, provides for disposition of owner's property in the same manner as in a will. But it's private, unlike a will, right? Irrevocable, a trust that the grantor does not have the power to change or revoke. Can you change an irrevocable trust? Yes, you can. But it's really hard. It's really expensive. And you have to go to court. And there's a lot of steps involved. The answer is yes, but I wouldn't want to go there. It's a bit difficult. And usually when you're talking to court, you're going to usually civil court, I think, generally civil court, and those lawyers don't necessarily know anything about estates or trusts or whatever. So, because I don't think it's under jurisdiction of the probate court, but the probate court, those judges are not experts on trust either. So, you know, so we have lawyers who kind of shop shop around the counties. Okay. Okay, polling question number 8 is up. When do you prefer webinars? You like mornings, afternoons, evenings, or you don't care? Okay. Okay, let's see. We got that. Okay, distributions. That's really, really important, right? How are distributions made, right? Uh, During the truster's lifetime, usually it just says that while I'm still alive, I get to take whatever income comes from the trust. I can take whatever principal I want. After the trustor's death, are there specific bequests? Is there a disclaimer trust, right? A disclaimer, right? You can disclaim your inheritance, a marital trust, residuary trust, retirement assets. So, now here's the thing about careful retirement assets. You can say anything you want in the trust. It doesn't matter. It's um, it's your designated beneficiary in the retirement account. That trumps everything. And we've seen cases, right? The Wall Street Journal had a really interesting case of a guy. He had a 401k plan. He named his girlfriend as the beneficiary. They broke up in 1989. They broke up in 1989. Um, and never updated his 401k plan. She got the money. Well, his kids sued. And guess what? You know what happened, right? The kids lost. They didn't, they weren't able to recover any of that money. So what? So beneficiary designate. We don't care what the trust says. We don't care what the will says. It's the beneficiary designation on the retirement accounts that trumps everything. And we have Supreme Court cases on that. So yeah, then that guy's case, he broke up in 1989. Probably forgot about her. Okay, Form 1041. The instructions are 53 pages. I think it's pretty good. Form 56, got the instructions to that. So very important. Notice concerning fiduciary relationship. Someone's got to get the letters, right? Because what if the house gets sold, everybody moves, we don't get the letters from the IRS, we'll miss things. And publication 559 for survivors, executors, administrators, 52 pages. And it's got a lot of good tips in there and worksheets and all those kind of things to consider. I think that takes us to our last slide here. So let me take a look at we did the last polling question, which is great. And let me take a look at our Q&A here, see what kind of questions we have. Okay. Okay, so Marie, if a residence in an irrevocable trust and the owner has can live in the house until death, does that qualify for a step up in basis? Well, step up in basis is based upon who owns the property. So if the owner of the property is an irrevocable trust, because the person who passed away put it in, it goes to the trust upon the death of that person, it will get a step up in basis upon the death of that person, right? Now the beneficiary is just the beneficiary. There's no second step up because it's within the trust and it won't qualify for 121 either. So there is no second step up in basis, only the first one, but not the second one. Okay, Arvin, trust addresses in New York. Beneficiaries reside, in a foreign country. Income not necessarily generated in New York State. Does the trust has to file a New York State return, and does the beneficiaries have to file a New York State return? Good question. I'm admittedly not a New York State tax expert. Boy, your state's tough to deal with. I've had to deal with your agents or whatever, and how come they all have Bronx accents? I don't know why. But anyway, they're all so difficult and terse. Well, this is a good question, right? Well, the trust address is New York. I assume the trustee is in New York, but the beneficiaries are overseas. So it kind of depends on the nature of the case. Is it coming from tangible income or intangible income? And that's when, all those issues apply and the countries and treaties and all those kind of things. So there's a whole lot more to look at there. Steven's got a question. Is 456 always required, or does the filing of a tax return put IRS on notice of the fiduciary? No, it does not. No, it does not. So 56 officially tells the IRS says, hey, I'm the trustee of this trust. Send me the letters if there's any letters. And if you have any questions, call me. So no, just by filing a return, that doesn't establish the fiduciary relationship with the IRS. Okay, I think I got all the questions, right, Phyllis? How we're doing here?
Yeah, I think we have no open questions.
I, I have a question for
Oh,
you.
fire
Great.
away.
Let me tell you, this was amazing.
Oh, thank you.
Love it, love it, love it.
Thank you. I like
You
it.
know,
You
what
don't have
you
a react
said,
button on this screen here. I
oh
get.
my gosh, I can't wait for conference to keep this going. But what you mentioned about the four-letter code and not having that second page on the EIN,
Yeah,
I
yeah.
have this problem with one of my clients who has in a revocable trust. Actually, no,
Mm.
it's not. It's an irrevocable trust he has. And I went to file a return and I'm like, rejection, right?
Got a
Because
reject.
that I did not have that. I
Did you leave it
tried
blank? If you left it
every
blank, it'll be a reject.
single,
Right,
I tried every single combination
right.
because I knew, yeah, it could be this, it could be that. Nothing worked.
Actually, the IRS, I've had this many times, and the back when you can call practitioner hotline, you say, hey, I got a reject. They're helpful because they go, what's the name of the trust? Okay, put in those 4 letters and whatever. It's also in the instructions. It's in the EIN instructions. It
Yes.
tells you how they come with the call.
How X did all of that, went through that, called the IRS out,
Yeah,
tried to get it. They were
yeah.
like, like there was something wrong with either the way, even I'm looking at the trust document,
And
the,
you,
the, the person cannot find this letter that they
there's
got. I asked them to go back to the attorney. I am stuck with this return,
there's an
cannot
there's an
get it
866
filed.
number. There's an 866 number you can call IRS to get a copy of that letter.
And that's what I
It's
told them.
under
I'm like,
the I don't have it in front of me here, but it's in the EIN webpage. So, it talks about the SS4 and then scroll down to the bottom of the page. It says, "Did you forget your EIN?" Call 1-866, whatever that number is, and from 7 a.m. to 7 p.m. And if you give me a second here, I can probably look it up because I just gave this information to someone because uh, I said, okay, you call this number. She said, hey, it worked. So
okay.
hold on, give me 1 second here. I
Okay,
look it up.
great.
Oh, here it goes. The 866. Oh, it's not 866. It's 800 number. Eight
Mm-hmm.
hundred 829 4933. And
4933. Perfect. Thank you
800
so much.
9.
And I have one other question for you on the
It's from
fiscal
7 to
year.
7. Yeah.
So 8294933.
Yeah.
Okay. All right. So then on the fiscal, because I have my client who died, and I elected to file a fiscal tax year because I figured we're going to get this done. Well, problem is, a week after the end of the tax year, the house was sold. And I'm like, gee, really? So I had redone the return as a fiscal year because I wanted to give us the time to wrap everything up because figured we could have gotten it done, right? Did not happen because the house, they put it up for sale and then it did not happen. So the fact is this. So is that an issue because I now have to file another tax return because I couldn't get it done? What's my
Oh, so,
problem there
so
now?
within that fiscal year period, you still got
Yes.
income. You're going to get a 1099-S. So we'll need to do another tax return.
So I have to now, yeah, exactly.
Yeah.
So what I'm saying it, because normally, yes, fiscal year hoping, but it's not a problem that I now have to still go and file a second year return because the property got sold outside of my tax year.
Right.
Not an
That happens,
issue,
right? Yeah.
right?
No, no.
Okay,
But
go,
make
because I'm,
sure I would highly recommend getting an appraisal to give us the date of death value. But
oh, we got all of that. All of that was
I've gotten
done.
some weird appraisals lately. It's like, really? Why is that so low? And the appraiser told me, well, it's because the interest rates are high and there's no sales in that neighborhood for the whole year or whatever, right? And it's like,
Mhm,
wow, I thought it'd be a higher number. But wow, I've been
mhm.
seeing that.
No comparables.
Yeah,
I,
that was
I
done. That was done. Thank you.
I had 2 questions and I just answered one of them, but I just want to make sure that I was correct. Deborah asked, husband and wife make joint gifts to children every year.
Uh-huh.
Gifts are below the annual deductible amount. Should
Right.
they file Form 709 every year just to be safe?
And that's a good question, right? So for
Oh.
2025, that's $19,000, the annual exclusion amount, right? So he gives 19, she gives 19. We're not really splitting gifts because they're each giving 19.
Mhm.
Now, if he gives, let's say he gives, what's 19 plus 19? Let's say he gives $50,000, right? He gives $50,000. Then that'll be a split gift, even though it's less than the exclusion amount. If you're claiming gift splitting, then you do have to file a 709 if you are claiming gift splitting. That's when you have to do it. But if he's giving money, she's giving money, that's not a gift splitting. They're each giving money out of their own accounts.
Okay, or if it was out of a joint account, then you wouldn't have to file either.
No, one from
Okay.
him, one from her, something like that. Yeah.
Okay, great. Thank you so much. And then Lisa had a question on here. She asked, if you pick the wrong type of trust on the return, is that a problem? Like what should you do? Like if it wasn't clear and you checked the wrong box?
Yeah, that happens, right? So, well, first thing though, let's say you checked a simple trust box, but then you entered on Schedule B that the trustee distributed $1,000, and and then you're going to get a diagnostic on your software saying, you can't be a simple trust if the trust is retaining any income. So usually at the preparation time, you'll get a diagnostic, and it probably won't even let you e-file, right? Or maybe your software is not that good and it makes you lets you e-file anyway. Then you might get a confusing letter from the IRS saying, "Hey, well, you checked a simple trust here, and I don't know. Look at the return to see how it came out, because if you checked simple, but then the trust only distributed a small amount of income, then the trust will owe taxes, right? Because they'll have a taxable income, um, and the software might not compute that. So if you have inconsistent information, I think the your diagnostic should point that out to you and say, no, 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 no. You need to correct this. Hopefully, right?
Yeah.
Great, thanks.
Yeah.
I just posted something in the chat for people who are still here. For split gifts,
Yes.
the IRS has some new instructions on how to file the 709, and there's a statement required, whatnot. It's a different format. And so Spidel does like a weekly tax minute, and
Hmm.
I just posted a link to that. They had a nice little presentation, a couple of minutes on that. So that's in the chat.
Yeah, I'm going to plug our friend John Sheely. On July 9th? I am doing a seminar for them on Form 709 and adequate disclosure. And the 2024 709 looks different than the previous years. And one of the differences is the split gifts.
Yeah.
Or on the old form, it was on the front page of the form, and you have to have the other spouse sign the
Yeah.
consent form, and there's no consent now. So that's
Yes.
changed a little bit here. They've made some change. Oh, there's a new question on the 709. The new question is, did you gift any digital assets? Ooh. That's just creeping into every tax form, isn't it? So
Yeah. It's
yeah, so I think it's July 9th. It's on their website. So I'm looking forward to giving that presentation.
Yeah, I think we have a question that came in. Can you speak a bit about an AB trust? Sounds like that's a little beyond the scope of our discussion, but Larry, I'll leave that up to you.
Okay, well, AB trusts, in some clients, ABC trusts. So you're, and this is something we did before the Tax Cut and Jobs Act. After Tax Cut and Jobs Act, we're not using the AB trust that much because most of our clients are below the basic exclusion amount. When it was 5 million, it became 10 million. Married couple, that's 20 million. I don't know about you. I have very few clients. I did have a client who was a billionaire for like a day, and then the stock went down. But I don't have billionaire clients. I probably don't want them either. But anyway, so AB trust. A stands for above the ground. B stands for below the ground. That's how I remember A versus B, right? So the B trust is the irrevocable trust. We put assets in that trust so that it won't be taxed again. It won't be taxed on the surviving spouse's estate. The A trust, of course, is part of the surviving spouse's estate, and she'll need to pay tax on that if it's above the exemption amount. But because most people are way below the exemption, also we have portability. We're not funding the AB trust right now. And for our wealthy clients, that's when we need the ABC trusts. So, um, so probably not that much today. So the state-of-the-art estate planning, we're working with their state-of-the-art estate planning attorneys we're not really focusing on AB trust. That's pre-Tax and Jobs Act. We're focusing on something called, well, we want the term flexibility. We want flexibility, taking advantage of what's called disclaimer trust, disclaimer planning. So you can disclaim part of your inheritance because you don't want it, you don't need it, or whatever, and that gives you a lot of flexibility. That's a whole other subject.
Larry, before we close, one of our attendees was just giving you such high praise in the chat. And
Oh, thank
she
you.
said she took an 8-hour class with another provider and she learned a lot more from you tonight than she did in that class. And she just, she's singing your praises.
Well, thank you much. I enjoyed doing
Mhm.
this, and I'm happy to do more. I have a diverse set of topics I can do.